Hello and welcome back to UK Finance Explained. In our previous lesson, we looked at how to read and understand a payslip. We identified important sections such as gross pay, deductions and net pay. Today, we are going to take a closer look at one of the most important parts of a payslip, payroll deductions. If you've ever looked at a payslip and wondered, why is my gross pay so much higher than the amount I actually receive? The answer is largely down to deductions. In this lesson, we'll explain what payroll deductions are, the most common deductions you may see in UK payroll, and how they affect an employee's take-home pay. So let's get started. Payroll deductions are amounts taken from an employee's gross pay before they receive their final take-home pay. Remember the basic relationship. Gross pay minus deductions equal net pay. Gross pay is the amount an employee earns before deductions. Net pay is the amount the employee actually receives after applicable deductions have been taken into account. So, for example, imagine an employee has gross pay of £2,500 for the month. After applicable deductions of, say, 500, the net pay would be the 2,500 less the 500, so they will receive, or the employee will receive £2,000 for that month. However, it's important to understand that not every employee will have the same deductions. The deductions depend on factors such as the earnings, tax code, NI position, pension arrangements, student loan obligations, and any authorised deductions. Payroll deductions exist for several different reasons. Some deductions are required by law. Others may be connected to an employee's benefits, agreements, or personal circumstances. For example, an employee may have deductions for income tax, national insurance, workplace pension contributions, student loan repayments, court or government orders, salary sacrifice arrangements, or any other authorised deductions. The payroll professional needs to calculate and apply the appropriate deductions correctly. This is one of the reasons payroll accuracy is so important. Even a small mistake can affect an employee's take-home pay. One of the most familiar payroll deductions is income tax. Income tax is generally deducted from an employee's pay through the PAYE system. So PAYE stands for pay as you earn. Instead of an employee paying all of their income tax at the end of the tax year, tax is generally collected from the earnings throughout the year. The amount of income tax deducted depends on factors including the employee's taxable pay, the tax code, the circumstances, the applicable tax rates and thresholds. This is why two employees earning the same gross salary might not necessarily have exactly the same income tax deduction. For example, one employee could have a different tax code from another employee, but we'll explore tax codes in much more detail in Lesson 8. Another common deduction is national insurance. Employees may pay Class 1 national insurance contributions through payroll when the earnings meet the relevant conditions. So national insurance is separate from income tax. So when you're looking at a payslip, you may see both income tax and employee national insurance listed as separate deductions on your payslip. So the amount of NI deducted depends on factors such as employees' earnings and the applicable thresholds and rates. It's important not to confuse employee NI with employer NI. The employee's contribution is deducted from their pay. Employer national insurance is generally an additional cost to the employer and is not simply deducted from the employee's net pay. We'll look into national insurance in much more detail in Lesson 9. Another deduction you may see on a payslip is a workplace pension contribution. Under workplace pension arrangements, eligible employees may contribute part of the earnings towards the pension. The employee's pension contribution can therefore reduce the amount they receive as take-home pay. For example, an employee might have £2,500 gross pay and the pension contribution of £100. That £100 could be one of the amounts taken into account before arriving at the employee's final net pay. The exact calculation can depend on the pension scheme and how contributions are structured. We'll look at workplace pensions in more detail later in the course. Some employees may also have student loan repayments deducted through payroll. This does not mean every employee will have a student loan deduction. It only applies when the relevant conditions are met. The amount deducted depends on the employee's circumstances and the applicable loan repayment rules. For payroll purposes, it is important to use the correct information provided through the appropriate payroll process. The employee's student loan repayment is then deducted from their pay. Not all payroll deductions are tax-related. Employees may also have other authorised deductions. So examples can include salary sacrifice arrangements, union subscriptions, charitable donations, childcare-related arrangements, repayment of certain employee debts, court orders or attachment of earnings, other deductions authorised under the relevant rules as well. So, however, employers cannot simply deduct money from an employee's wages whenever they want. There are legal requirements governing when deductions can be made. So payroll professionals therefore need to understand the difference between mandatory and authorised deductions. This is an important distinction: mandatory or statutory deductions. These are deductions that are required by law when the relevant conditions apply. So, for example, it could include your income tax, employee national insurance, certain student loan repayments, certain deductions required by court or government orders. Voluntary or authorised deductions, these are deductions that may arise because of an agreement, benefit, arrangement, or employee authorization, and subject to the applicable rules. So examples may include certain pension arrangements, union subscriptions, charitable giving, certain salary sacrifice arrangements. The exact treatment of deductions can vary. So payroll professionals should always follow the applicable rules and the employer's payroll procedures. Let's put everything together. Imagine an employee has gross pay of $2,500. The pay slip might contain deductions such as income tax of $250, NI of $120, pension of $100, and then a student loan of £50. The total deductions would then be $250 plus the $120 plus the $100 plus the $50. So that would be your $520 total of deductions. The employee's net pay would therefore be the $2,500 minus the $520, which will be equal to the $1,980. So gross pay $2,500, total deductions $520, and then net pay £1,980. This is a simplified example for learning purposes. Actual payroll calculations can be more complicated and depends on the employee's circumstances and the rules applicable to the payroll period. Imagine an employee expects to receive £1,980 but receives $1,750 instead. They are likely to notice payroll errors can cause incorrect employee payments, employee complaints, additional administration, corrections in future payrolls, incorrect reporting, or even potential compliance problems. So that's why payroll professionals need to carefully check deductions before finalizing payroll. A good payroll process should include reviewing calculations and investigating anything that looks unusual. Before payroll is finalized, a payroll professional should consider, is the employee's gross pay correct? Is the correct tax code being used? Are income tax deductions correct? Are NI calculations correct? Are pension contributions being handled correctly? Are student loan deductions applicable? Are other authorized deductions correct? And even does the final net pay look reasonable? This checking process helps reduce payroll errors. One common mistake beginners make is assuming every deduction on a payslip is tax. That's not correct. A payslip can contain several different types of deductions. So, for example, income tax is a tax deduction. However, NI is a national insurance contribution. Pension related to the employee's pension arrangement, and student loans are repayments rather than income tax. Understanding what each deduction represents is an important payroll skill. This is where payroll can become more complicated. Some benefits or arrangements can affect how an amount is treated for tax or NI purposes. So, for example, salary sacrifice arrangements can have different payroll treatment from an ordinary deduction from the net pay, right? Therefore, payroll professionals should not simply assume that every deduction is subtracted from gross pay in exactly the same way. The treatment depends on the type of deduction and the relevant payroll rules. For beginners, the key principle is identify the deduction first, then apply the correct payroll treatment. Let's summarize the basic process. So firstly, we've got gross pay. It leads to us calculating the applicable deductions, which can include things like income tax, NI, pension, student loan, and any other authorized deductions. Then we've got our total deductions, and we're going to take that total deductions from the gross pay, and you're left with the net pay. So the final amount is the employee's take-home pay, basically. Let's look at a simplified example. Meet Emily. Emily earns 3,000 gross pay for the month. Her payslip contains the following simplified deductions. Income tax £400, NI 180, pension 120, and then she also has a student loan of £50, which she repays each month. Let's calculate the total. So the 400, 180, 120 plus the 50 will be the 750 total deductions. Now calculate Emily's net pay. So it's the 3,000 less the 750. And then if we simplify the payslip, the simplified payslip should then show the 2250 that is left over as a net pay. But again, this is a simplified trading example and not a real payroll calculation. Before we move on, please don't forget to download your UK Payroll Fundamentals workbook and activity guide, packed with practical exercises, quizzes, and case studies. Link below in the description box. You can also find the free UK Payroll Fundamentals starter pack there as well. Learn, understand, and succeed. Before we finish, let's recap some important terminology. Gross pay, the employee's pay before deductions. Deduction or deductions, an amount taken from an employee's pay under the applicable rules or an authorized arrangement. Income tax, tax generally collected from employment through pay as you earn, NI or national insurance, contributions that may be payable by employees and employers depending on the circumstances. Pension contribution, an amount contributed towards a workplace pension. The student loan repayment, a payroll deduction that may apply to employees who meet the relevant repayment conditions. Net pay, the amount remaining after applicable deductions. So the amount that is you will receive actually in your bank account. So what have we learned? Payroll deductions are an essential part of the payroll process. We have looked at all of these things on the screen, and the most important thing to remember is that not every deduction is the same. Each deduction has its own rules and payroll treatment. As a payroll professional, your job is not simply to subtract numbers. You need to understand why the deduction exists, whether it applies, and how it should be processed correctly. In our next lesson, we'll take a closer look at one of the most important pieces of information used in UK payroll: tax codes. We'll explain what a tax code means, why it matters, and how it affects the amount income tax an employee pays. Amount of income tax an employee pays. So thank you for watching and for joining me, and I will see you in lesson 8, I think it is. Yep. UK Finance Explained. Learn, understand, and succeed.